Alan, Dragon Oil is one of the best performing oil stocks in the UK this year. It's also one of the few exposed to Turkmenistan and Central Asia, and it's the subject of a takeover bid. What's been going on?
The major shareholder in Dragon is called Emirates National Oil Company. They own about 54% of the company. They have for some time tried to completely take over the company and buy out the minorities. They've tried again. They've put up a bid now around £7.50, and the independent directors have recommended the bid to the board. There is one problem. The next biggest shareholder with 7%, Baillie Gifford, is contesting it, saying the company is actually worth more.
Okay, it's always a risk when a major shareholder takes over or tries to buy out the minorities in a company, especially when those minorities are heavily concentrated in retail investors, that they will offer a lousy price. Is that the case here? Has Baillie Gifford got a case?
I think in this case they don't. In the past, in 2009, they contested with some other shareholders the bid from Enoch, as we'll call them. That was closer to £4.50 with a higher oil price, with oil production still to rise at that point. But now it seems like this is a fair bid. Analysts I've talked to would put a core net asset value for the company in around £6.50 or so, maybe even less. There's reason to believe that it's a full price. Baillie Gifford feel that there's potential for more production growth. They see the company putting in certain measures that will add more barrels in the years ahead. Plus, the company seem to be putting in some very large pipelines. Understandably, Baillie Gifford says, "Hey, there could be more production here. Why should we sell out here?"
And what do you think will happen in this instance? Do they have enough to force a higher price, or do you think it will go for what Enoch have offered?
Well, they have form. They were pretty good on the last time, and as I said, $4.50. Now they're getting $7.50. That's pretty good. But I think in this case, I'm not sure I agree with their argument. The argument that this enhanced oil recovery, which involves shooting water into the wells and lifting this oil out, what will probably happen is that water will get mixed up in the oil. There'll be a greater volume of fluid that comes from these offshore wells. You will need bigger pipes over time. It may well be that that's what these large pipes are going to be for. There are other costs that are coming involving decommissioning of these wells over a longer period of time. Money has to be put into escrow for that. They may not have accounted for that in their net asset value. So I think $7.50 seems a fair price to me.
Thank you very much.